This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Good luck chasing momentum. Yes, it's worked for some this year, but market sector and individual stock volatility are soaring. Up next, we're being reminded in real time that nothing works forever. And you better make sure you're prepared for the inevitable, that today's winners will become tomorrow's losers and vice versa. How to think about this? Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Volatile week. It's been volatile for many asset classes, right? Just not so much the stock market. We've already seen bond yields hit their highest levels this year, surpassing the peak in May. 10-year Treasury, as of the end of the week, was back up over 4.7%. Gold in free fall. Gold down now almost 30% from its peak earlier in the year. U.S. dollar has gone up. Why? Well, several things. Of course, we've had a pretty significant resurgence in the conflict in the Middle East, as we all know. And then on top of that, might we be getting back to a trade war? We saw President Trump this week levy a 50% tariff on some imports from Canada using his Section 301 authority. Just adds a lot of volatility. But it was just at the end of this week that stocks started to be catching up. Up until now, stocks have largely ignored that and instead been focusing more on corporate fundamentals because we're just in the early stages of second quarter earnings reporting season. So a lot to deal with right now. I think the question is, what is the underlying backdrop, and has that really changed that much? And I'm not sure it has. I mean, if you look at the Economic Surprise Index, which is something I follow closely, that's essentially a measure of the economic data coming out relative to consensus expectations, and it's been improving pretty significantly over the course of the last 6 months, including some pretty favorable employment data just this week. So the economy is still chugging along despite the headline volatility. And of course, from a stock market perspective, as it has been the case really for the past 2 years, it's been driven by earnings growth. Okay, so despite tariffs, despite higher oil, despite geopolitics and policy volatility, corporate earnings have continued to move forward at a double-digit pace. And interestingly enough, if you look at the S&P 500 performance this year, all of it has come from earnings growth. Okay. Meanwhile, valuations on those earnings have actually contracted. Valuations are down almost 10% so far this year. So the market has actually not gotten more expensive. It's gotten less expensive, but earnings have done well. Okay. So I don't think it's an accident that this earnings reporting season has been very volatile, right? Because the bar for earnings is so high. And if you've been following things closely like I do, I mean, we're seeing 10, 15% drawdowns in stocks that seemingly have produced good reports, but maybe not reports that were quite up to expectations. You know, if the stock was supposed to grow 20% and they come in at 19%, you're going down 10%. That's kind of the environment that we're in right now. So it's very important that you understand the story behind the stock reaction. If you're just reacting to price, you may come away with a somewhat distorted picture of the underlying health of that particular company. I will say, and Goldman Sachs noted it this week, that valuations, even though they have contracted a bit, they're still elevated by historical measures. But they're saying that could continue to be the case for the foreseeable future. When macro conditions are largely favorable, and I know oil's gone up, I know rates have gone up, but when overall conditions are still relatively favorable, as they are here in the United States, valuations can stay this way for an extended period of time. But I wanted to shift a little bit. The working title of this podcast is Nothing Works Forever. Wanted to talk about volatility. At the market level, the index level, volatility has actually not been that significant. You know, I've talked about the VIX before, VIX, which is a measure of market volatility that a lot of professionals and individual investors follow. It's actually in a historically average range. So despite all the stuff we've been reading in the paper, the VIX really hasn't moved all that much except for a couple spikes, earlier in the spring. But underneath the surface, it is a much different picture. You may have heard that analogy. It's a little bit of a hackneyed analogy, to be honest with you. But the analogy of a duck, paddling across the lake. On the surface, the duck looks calm, right? Not a lot of head movement, not a lot of body movement, but there is a frenetic activity, the paddling, beneath the surface. And that's kind of what the market feels like. And I'm going to get to that in a second. Just as a bit of an amusing side note, I read a piece from Joe Wiggins. He's a guy I followed before. He writes for a blog called Behavioral Investment. And he was talking about a deck of playing cards, 52 playing cards. And he was asking the question, if you laid out just the hearts, so what's that, 13 cards out of 52? You lay out the hearts. How many different orders can those 13 cards be dealt in? Well, guess what the answer is? Over 6.2 million. 6.2 million. And if you did it with the whole deck of cards, lay out the whole 52, it's a number so big, it's almost hard to calculate. And of course, this is where the number of cards is fixed. The rules of the game are simple. You know all the possible outcomes. I bring this up because, a client asked me the other day, and I'm not picking on this client, it's a common thought. He said, what do you think the market's going to do over the next month? Well, this is why I thought of that, because when you're dealing with a deck of cards, that's a closed, a well-ordered system, right? But when you're dealing with an unfathomable number of inputs, where there's a significant amount of path kind of dependency, right, where each step in the global economy or the market influences what occurs next, where it's an adaptive environment, where people are changing and forming opinions in real time. Think about the range of outcomes in the markets. It's got to be a multiple of 6.2 million, right? So I just say this because we all read headlines, we all watch the same cable news programs where you had these talking heads offering forecasts, often short-term forecasts for the coming weeks or months. Turn the channel. It is not worth your time. But I was reminded of it's all in the context of short-term volatility, right? And what we're finding is a lot of this short-term volatility does not necessarily have a lot to do with fundamentals, okay? It has to do with sentiment shifts, opinion shifts. But just to give you a few things to sort of chew on, I talked about the VIX, which is a measure of index volatility, like S&P 500 volatility. But according to Goldman Sachs, if you look at what traders are paying to hedge against big moves up or down in individual stocks, that has gone through the roof. So the spread between relative calm in the VIX and extreme volatility in individual stock moves is the widest that we have seen in a long, long time, and it'll probably end up being a record year for that. We'll probably surpass what we saw at the peak of the dot-com bubble, back in 1999, 2000, early 2001, okay? So you were seeing a lot of individual moves. So that's kind of the landscape that we're dealing with. And we're also seeing it, of course, at the sector level. And I've talked about this a couple weeks ago, the last time I did the podcast. Tech, of course, at times this year has been the best place to have your money. So far here in July, it's been the worst place to have your money. And, of course, we've seen big swings in energy. A lot of that has to do with crude oil prices and the war, but also big swings in financials. It was just a couple months ago that financials and healthcare were the two worst performing sectors in the market, underperforming the S&P by, both of them were underperforming by over 15% year to date. Well, healthcare has been in a leadership position recently, as has the financial space. So some of it is just probably repositioning, selling the winners and buying the losers, just kind of rebalancing at the institutional level, but also it's sentiment driven. So again, you are seeing a lot of volatility underneath the surface. I would also note, Larry Adams here at Raymond James noted it this week, that as of July 22nd, I guess that was Wednesday, the average stock in the S&P 500 was down 17% from the peak. 17%. Meanwhile, The index is only down, again, as of the same date, I think 1.5% from the peak. So again, what does that speak to? Individual stock volatility, the frenetic paddling of the duck beneath the surface. So why should you care? Well, you may not care if you're just, on vacation and following your accounts, once a month or, maybe when you get back from your trip, and that's probably the right way to go about this. But if you're actually in the weeds on this, I think it's really more of a lesson than anything else. One is be prepared for this. I mentioned how the stock price reaction to an earnings report may not be an accurate reflection of the long-term merits or lack of merits of a particular individual stock. Remember what I said. If the market was expecting 20% and you come out with 19 or come out with 21, you might get a 10% down move or a 10% up move, even though overall there's not a whole lot of difference. So when you look back on it 2 years from now, you're probably not going to care, but in real time, you're going to be experiencing these huge moves. Okay? And again, from a kind of an investment management perspective, I think it provides some opportunity, right? If you have a company where you really believe in the secular story, the longer term story, but maybe in the short term there was an execution hiccup or, I've seen stocks where they missed their earnings or companies where they missed their earnings just because a big sale was getting pushed forward to the next quarter. It was a timing issue, not a execution issue or a sales issue. Understand the company behind the stock price. That's sort of the message that I would send. Just to look at it a little bit further, there are these things called factors. If you're an institutional investor or an algorithmic trader, not so much what you and I do as individual investors, but there's certain factors that these guys follow, whether it's value or momentum or low volatility or high dividend. In other words, groupings of stocks that are doing well or not doing well at any particular time. Well, guess what's been the best performing factor for most of this year? Momentum, which momentum is pretty easy to explain. It's essentially buying things that are going up. That's what momentum is, okay? And keep owning them until they stop going up. Okay, sounds pretty simple. That has worked actually relatively well in a number of areas. The current sort of momentum trade du jour, if you will, has been memory chips, right? We've talked about this. Last year it was the Magnificent Seven, right? And what happens is when something's going up consistently, there's this semblance or air of infallibility, right? That it's never going to stop working. And generally speaking, individual investors come into that trade and they think they're geniuses because they're buying something. Oh, geez, it goes up the day that I buy it and keeps going up, right? Here's the problem. If you look at last year, momentum was one of the worst factors to follow. In fact, last year, the growth factor dramatically outperformed momentum. This year, growth stocks have been one of the worst performing places to have your money, large U.S. growth stocks, okay? There have been times where value is the best place to have your money. There have been times where low volatility stocks have been the best place to have your money. So again, what's the lesson here? Nothing works forever. Nothing works forever. And the shifts in what's working can change dramatically and without warning. I mentioned the Magnificent Seven. We all know that for most of last year, a good chunk of the previous year, that was the trade. Just buy the largest 7 tech stocks, go to the beach, you're going to make 20%, right? Well, Magnificent Seven has become an anvil on the market this year, okay? As of late this week, I think the Mag 7 was close to flat. And 5 out of the 7 Magnificent Seven stocks were down for the year. 6 out of 7, the lone exception being Apple, were in the midst of a more than 20% drawdown. So I'm not really offering a comment about the future of the Magnificent Seven. It could look a lot different. At some point this year, next year, it would not surprise me in the least if the worm turned and you had renewed interest in the Magnificent Seven. Follow the long-term track record of of Alphabet, Microsoft, Amazon, they've all had periods of underperformance. They've all had periods of 20, 30% drawdowns only to eventually trade at new highs. But in the short term, what had been the place to be, what had been the momentum story, the momentum narrative, has given way to something else. Okay? I mentioned Apple briefly. Apple's kind of a case in point of why you need to understand the fundamentals behind the stock price. It's why you also need to understand shifts in sentiment. Apple made a new all-time high within the last week. And yes, they pulled back a little bit the last few days, but still only a couple percent off their all-time high. Did you know that? Maybe not, because it has not been much of a story. I don't know. I mean, most of you have followed Apple pretty closely over the years. Remember when Apple was the story? When they came out with the new iPhone, there was a line around the block, and that was the video on all the talk shows was the Apple line and people being interviewed in line. Remember all that? An iPhone launch was a national event. That has changed over the course of the last year. Apple's not sexy anymore. It was chip stocks get the attention, right? AI gets the attention. I think one of the easiest mistakes investors make, particularly individual investors, is chasing what everyone else is talking about. That momentum factor, right? Because it's so hard to know when to get on the bus and when to get off the bus. And most people get on the bus right as it's about to get to the stop. So you pay your bus fare, and then you're getting off 10 feet later. That's essentially what most individual investors do. And what's also interesting is Apple, the company itself, really hasn't changed much. They've had a pretty consistent message and story that they're monetizing their service business. They're getting everybody who has an Apple phone, yours truly included, to buy more stuff, buy more services, whether that's Apple Pay or the music library or whatever it is. Okay? So the company hasn't changed that much. But Apple, the stock price has. And what's the catalyst behind that? Well, there is a bit of a fundamental catalyst. And the main catalyst is that they haven't spent money. Put it this way. Apple spent about $13 billion on CapEx last year, capital expenditures. $13 billion. Amazon spent over $200 billion. 15, 16 times as much. Okay, so that's the story, that the market is no longer rewarding, and I'll get to the Google earnings in a second, the market is no longer rewarding spending on AI. So here's Apple having their day again because it was essentially a forgotten name. Look at banks. The KBE, which is the S&P 500 Bank Index, has spent almost 20 years getting back to the highs that they made before the great financial crisis. 20 years. Just got back to a high 2 weeks ago. So you see where I'm going with this, right? Buying what is sexy, buying what's hot, it can work for a short period of time. It can be work if you're really super smart and you're a sophisticated trader. But for 90-95% of we mortals, it is a much more difficult thing to do. So I'm not saying don't own what's going up. I'm not saying that. You don't have to be contrarian all the time, right? I mean, what's that old expression? Just because everyone has an umbrella doesn't mean it isn't raining. But just be cognizant of being too levered to the momentum du jour. There's that old cliche about diversification from an advisor standpoint, always having to say you're sorry. And what I mean by that is if you were truly diversified, there's always something in your client's portfolio that stinks, that's losing money, that's out of favor, something you're always having to apologize for. Now it might be bonds, right? As of this week, the bond market has a negative return so far for the year. So a client calls up, asking about their performance, I'm apologizing. Sorry, we own these bonds. That's what's been the drag for the most part. I'm generalizing here, but I'm saying there have been times over the past 5 years where advisors have had to apologize for owning small cap stocks, international stocks, emerging markets, Banks, I just mentioned banks. Owning Apple, apologizing for owning Apple. But diversification means that you are less leveraged to a one-directional trade. And over time, that probably is a good strategy, even if it's unpopular for shorter periods of time. Just wanted to make one more point. Obviously, there are a lot of reasons why things could go wrong. I mean, I think most of us listening here can identify those reasons, right? I mean, people talk about higher inflation. We all know about the war, higher oil prices, the Fed raising rates because of higher oil prices and inflation. A lot of talk about an AI bubble. But the only reason I bring all this up is if you look at surveys of what the biggest risks are. So I was reading PwC's Market Volatility Survey, where they poll financial service executives. Top concerns: geopolitical events, inflation, interest rates, government policy, uncertainty. I went to McKinsey's June Economic Conditions Survey, same type of polling group. Geopolitical instability and energy prices are the leading risks. Went to Natixis. They do a poll. Oil prices, inflation, possible hit to consumer confidence. Last one was Bank of America's July Global Fund Manager Survey, where they talked about AI bubble as their biggest tail risk, followed by inflation and geopolitical conflict. Why do I bring this up? All these people are saying the same thing. They're all worried about the same stuff. Now, it doesn't mean that those things won't happen, but it does mean that those risks are being widely contemplated by the vast majority of investors. That means to me that, it doesn't mean that the markets won't go down if some of these things transpire, but it does mean a lot of those risks are getting increasingly priced into the markets. And I would call it a positive. I know that sounds a weird word to use, but a positive, because when people aren't worried about anything, when they're too fat and happy, that's often where you get the biggest risk, right? The biggest vulnerability to risk is probably a better way to put it. You've heard that expression, the market climbs a wall of worry. That's kind of what we're thinking about. And the real risks, and we've seen this over the last 20 years, the real risks are the things that you don't expect. COVID was a blind side. Silicon Valley Bank a few years ago going bust. That was a bit of a blind side. Iran war was a bit of a blind side. I mean, that wasn't on most people's dance cards. Tariffs being much worse than expected 15 months ago. That was a bit of a blind side. Those are the things that really move the markets, and by definition, they're blind sides. They're black swans. They're things that are not in people's models. So again, I bring all this up because if you are reacting in your portfolio to risks that are on the headline of every paper in the country, it's probably not the smartest thing to do. And I also don't think you should be kind of positioning your portfolio so dramatically that it only makes sense in a 3 or 4 or 5% type market scenario. In other words, if you think there's a 3% chance that the market goes down 40%, does it make sense to go all to cash when it's only a 3% probability? Probably not. I think the way to think about it is to keep invested, but then have contingencies for worst case scenarios. And that contingency might be having some cash, might be having some fixed income, might be having a safety valve if the market goes through a downturn. Obviously, you have to make that decision at the individual client level, the individual portfolio level. But I see too many people positioning their portfolio for low probability outcomes. The one thing I'll say is I just want to make one more point about fixed income. I didn't plan on talking a lot about bonds today, but I mentioned how bonds are out of favor and how the 10-year Treasury yield hit a yearly high this week. 10-year Treasury is now up over 4.7%, which surpasses, as I mentioned, the peak in May. Well, one man's trash is another man's treasure, so existing bondholders, yields go up, prices go down, right? But if you're buying bonds today, well, you could buy treasuries, like I just mentioned, but you could also buy corporate bonds or municipal bonds with yields or after-tax yields of, greater than 5%. And I'm talking about high-quality paper. And remember, and I've said this 1,000 times, but I'll say it again, there is a very high historical correlation between starting yields and future returns, meaning if you get 5%, if you lock in 5% today, it's a 90+% chance that's about what your return's going to be over the next 7 to 10 years. I don't know what stocks are going to do over the next 10 years. Maybe it's 10%. Maybe it's lower than that because we've been above the 10% average in recent times, right? So if we do have some sort of reversion to the mean, maybe it's 5 to 10% for stocks. Well, if you can get 5.5% yield on good quality bond portfolio, that's not so bad. Meanwhile, it offers you some stability, or at least relative stability, if the stock market continues to get a little bit more turbulent. Even our existing bondholder, that's one of the reasons why we like individual bonds. Remember, if you buy a bond at 100 cents on the dollar and it's a high-quality bond and rates go up and it goes to 95 cents on the dollar, you have a 5% paper loss. But if you hold to maturity and that bond remains solvent, you're going to get your 100 cents on the dollar back. Okay, so again, I'm not coaching you into individual bonds. That, again, is a personal decision with your investment advisor. But here at the Wise Investor Group, we've always had a preference for individual bonds. So we have that type of visibility and transparency into our clients' fixed income returns. All right, I'll leave it there. Stick with me. I'm going to take a real quick break here. And when we get back, I do want to just offer a few comments on what we've heard from some of the holdings in our portfolio who are just starting to report second quarter earnings. Back in a sec. Midterm election years are almost always the most volatile, and so far 2026 is proving no exception. Will you let the inevitable churn in your political leanings disrupt your plan and portfolio? Tune in every week as we discuss the latest financial trends and what investors need to know. To avoid the endless barrage of distractions and become a better informed, wise investor, listen to us at The Wise Investor Show at RaymondJames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the Wise Investor Show. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. As promised, I do just want to offer a few quick thoughts and observations on some of the names in our client portfolios that have reported second quarter earnings over the course of the last couple weeks. Remember that the names I'm going to talk about are names that we do own for a number of clients and I own personally, which is a conflict of interest. So make sure you consider that when thinking about these. And of course, you need to do your own research to make sure they're appropriate for your particular portfolio. I mentioned the fact that the bar is high for earnings. First quarter earnings were up over 20% year over year. And all the return in the S&P 500 this year has come from earnings growth. Valuations have actually been a headwind, not a tailwind. Valuations have actually contracted, meaning people are paying less for earnings. So those earnings better be good. Nowhere are we seeing that more than in technology, of course. And the big story, I think you're already aware of this. I mentioned how the Magnificent Seven stocks in aggregate have been underperforming this year. Well, that's because the spenders are basically underperforming the people that they're buying from. Okay, so the hyperscalers like the Googles, Amazons, Microsofts of the world, Meta/Facebooks of the world, who are buying chips to support their AI, CapEx build-outs, they're the ones suffering. And again, the suppliers to those companies are the ones that have done the best this year. Now, that could flip-flop. It was the opposite last year, but that's kind of the status today. Alphabet is the poster child of that. And I thought it was very interesting that Alphabet, formerly known as Google, their stock pulled back 5-6% or so after their most recent report, despite the fact that they had blowout numbers. Okay, so according to Deutsche Bank, Alphabet had consolidated revenue up 24% year over year. That was well ahead of estimates. Their search revenue growth was up 17%. YouTube ad growth up 13%. A stunning 82% increase in their cloud revenue. All of those were well ahead of street expectations. But again, the stock went down 6 or 7%. So what's going on? Well, on a positive note, Alphabet is already monetizing. There's been a lot of talk about monetizing AI, not just spending, but actually, reaping the benefits of AI financially. They're doing that at scale. AI overviews in AI mode are increasing their search volume. You know what I'm talking about. When you Google something, it's now an AI search, right? That's much more effective than the search used to be. Gemini, their AI agent, is improving their ability to understand and monetize longer, more specific searches. Their AI Max product, which is their kind of advertising product, in beta testing, helped advertisers get 15% more conversions on a similar ad spend. So all those things are very positive for their earnings. Their cloud outperformance, equally important, strong demand across all platforms. And also Google is actually not just renting infrastructure, they're actually selling chips as well. Okay, so Google is unique in the sense that they have an integrated stack of chips, networking, models, software, security, and enterprise distribution, all kind of folded into one. And that's not even talking about Waymo. It's not even talking about YouTube, some of their other things. Okay, but what's the problem? Why did the stock go down? Well, they increased their spending estimate. Again. And then they hinted at the fact that that is going to impact margins, right? Because they're having to spend. And then, of course, that is going to create, in the short term, negative free cash flow. Now, Google is saying, well, these are expenditures worth making, right? Because you can see the growth that we're having. But the market is not focused on that. So if you look at ROI, return on investment, the market is focusing on the I. Google management is focusing on the R, okay? And unfortunately, the I is winning out. The stock has been down over the course of the last few months in the context of a double-digit drawdown. So, obviously the risks are that you don't see enough of the return to justify the investment. So that's the risk if you own Google right now. But I would also make the point that the proof does seem to be in the pudding, and the explosion, and I'll use that word, the explosion in earnings and revenues on multiple fronts to credit management seems to be justifying the expense, at least so far. The valuation is not that demanding either. Google is now trading in the low 20s in terms of price to earnings, so it's not like Google is a super expensive stock and that you're overpaying for growth. So again, consider the risks. Obviously the market is. That's why the stock is pulled back, but again, as I said earlier, it would not be surprising to me if the script flips at some point over the next year or two and people start to notice that these hyperscalers are trading at a discount to the S&P 500, which could be the case if the stocks continue to underperform. Switch gears a little bit. I'm going to mention it's easy to pick out winners and talk about things that are going well. I'm going to highlight a couple names that have not done well recently and sort of what the story is. One is Netflix. Netflix, for anybody who owns Netflix, it's been a big disappointment in terms of share price, trading pretty close to a 52-week low. And when they came out with their earnings, I read a really good report from Evercore ISI on this. Let's be honest, their fundamentals were soft. They had revenue growth deceleration, operating margin declines, and they kind of signaled to the street that they're going to be less frequently reporting their viewer numbers, their engagement numbers. They felt that created too much volatility when people were focused on monthly results. Wall Street doesn't like that. Wall Street wants more transparency, not less transparency. And of course, the stock traded down on that. But let's try to see the forest through the trees on Netflix. As Evercore pointed out, they are still a very high-quality asset, global leader in video streaming, supported by unmatched scale, proven content production engine, and differentiated premium paid subscription model. Sustainable 20% grower based on an algorithm, again, according to Evercore, of low double-digit revenue growth, solid operating margin expansion, and share repurchases. And they're trading at a multi-year, almost a decade-low valuation of about 18 times next year's earnings. So that algorithm seems to be intact. And there's some things that I think are worth noting about them. And they're still a hit factory. Yeah, they're kind of having the Stranger Things hangover, right? They don't have that kind of must-watch program right now, but that's probably a temporary thing. They continue to produce things that people watch. They're getting more into live events, particularly sports. They realize that has the potential to expand their total addressable market. Their ad revenue doubled year over year, so they are successfully monetizing Netflix. And I think they're taking short-form entertainment a lot more seriously. You know, we've seen how successful YouTube has been, which of course is, I think, an undervalued asset that Google has. YouTube is kind of eating the world. You know, people are spending 1 or 2 minutes a lot more than they're spending 2 hours. Netflix, I think, will continue to take that more seriously. And Netflix is also starting to see that there's a pretty clear pathway towards margin expansion, okay, because they are less capital intensive than they were a couple years ago. So they think that's going to be the case. So, I mean, the risks are kind of obvious. I think, you know, the market is still trying to figure out what Netflix's strategy will be. I mentioned live programming, particularly sports and short-form video. Those are the two things that they're starting to get into. I think market wants to see more clarity around that strategy and how much it's going to cost. I think the market's also nervous about them making a huge acquisition. They were in the running for Warner Brothers a couple months ago. Luckily, they didn't get it, at least for Netflix shareholders, because that $70-80 billion deal was not viewed upon very favorably. So there are definitely risks to the story. But at 18 times earnings, at least a chunk of those risks seem to be accounted for. I certainly think the Netflix story is going to require patience, okay? Another stock that's been frustrating for a lot of investors has been Danaher. You may recall Danaher is a diversified life sciences company. They do bioprocessing. They do a lot of protein synthesis for drug studies. A lot of sort of the picks and shovels behind the pharmaceutical industry. They also, of course, did really well a few years ago during the COVID era because they were very much involved in testing and lab processing. There's been sort of a multi-year hangover from the explosive growth that they had a few years ago. I think the big problem at Danaher is twofold. One is they were trading at 35 times earnings, and their valuation multiple has almost been cut in half. So it took a long time for them to go from being expensive to being reasonable. And I would argue that Danaher is kind of at that inflection point where I'd say they're a value stock at this point. So I read a really good piece from Deutsche Bank, and they were just making the point that, yes, it's been a frustrating story, but you have a pretty clear algorithm that gets you to 5% plus average revenue growth, 15% average earnings growth, and a trading multiple half of what it was. That's kind of what they were saying, and I think that makes a lot of sense. The base case going forward with a high degree of confidence is high single, as I mentioned, to low double-digit earnings growth. They have a significant backlog. If you look at this most recent quarter, the stock took a big hit after their release. A lot of it was timing. There were orders that should have been booked in this quarter that got pushed to next quarter. So, interestingly enough, one of the things that they note is the consensus earnings forecast for Danaher has actually increased by 2 to 3% this year. So even though the stock price has been struggling and valuations have come down, earnings forecasts have actually gone up. Okay, so you remember that the late Rick Malone, our founder, used to talk about a coiled spring where earnings are increasing, forecasts are increasing, but the multiple is collapsing. At some point, that spring uncoils. The risks are kind of obvious that Danaher's growth targets have not accelerated in the way that some people had hoped for. They were very conservative on their revenue targets going forward. So that's why the stock has been kind of stuck in the doldrums here. But at this point, the valuation that you're paying, similar to Netflix, reflects a lot of that anxiety, a lot of that trepidation. So balanced, I just want to make sure I give you a balanced picture there because there's a reason why the stock is negative for the year. But if you're a value investor, which I know a number of you are, maybe something worth taking a look at. I think I'll leave it there. There's certainly other names that have reported, but I want to make sure we save some material for the next couple of weeks. We're about a third of the way through earnings reporting season. My colleague Chase Hinderstein will be back with you next week. I'm sure he'll have some individual updates to share with you as well. Until next time, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.